UMF. We truly appreciate the opportunity to speak here today. You guys have an incredible crowd on here, and it's just a true testament to the type of service, you guys provide to your clients looking for unique solutions. So we've successfully completed over 1,000 1031 exchange transactions for clients. That equates to about $2 billion plus in client exchange proceeds. So we're the record holders in the largest 1031 exchange and DST transaction in history, which we're going to get more into what the DST actually is, but we are the record holders for that type of transaction to date. Just to get into the broad scope of the commercial real estate market here, real estate values, most markets since 2008, we've seen a V curve, right? So we've been just riding upwards nice and steady since 2008. A lot of sellers are seeing a lot of gains. They're seeing a lot of appreciation. We work a lot with baby boomers, people that own commercial real estate and investment properties, and they've been in these assets for 10, 15, 20 plus years. So now that we're at the peak of a market, or at least a market that looks feasible for that, we're seeing a lot of sellers that are receiving off-market offers, or they're receiving some interest on their properties. They're looking to lock those gains in. And we're also seeing a lot of buyers out there that are really eager to secure new properties and build out their portfolio. So the demographic trends that are really fueling a lot of the turnkey requests that we've been seeing, passive investment requests that we've been seeing, has been the population kind of increasing in age through the baby boomers. It's a huge wave of baby boomers that own commercial real estate investment properties. And, they're looking for some other type of solution other than going into maybe a passive Dollar General or a passive Walgreens, because there's still management responsibilities that you have to take on, even with those types of assets. Renegotiating leases, having to do any structural improvements to the property if it's double net, not fully triple net, and then you're still tied to one single asset. So these are the types of analytics that are really building us to educate the masses on the DST and kind of give everybody another solution out there. So the velocity of today's market, there's a huge thought process around 1031 exchanges being difficult to do. And it's absolutely not the case. 1031 exchanges are, and Rich will tell you at UMF, because they do a lot of 1031s and they work with a lot of clients who trade in and out. It's easy to do if you have the correct team around you, like UMF, like ourselves, quarterback in the transaction. And we commonly, unfortunately, see a lot of exchanges that are not done properly, or they don't line themselves up properly. And then that can cause a headache. So, John Paul, we just worked through a case together with that marina sale. If you want, maybe just go into a little bit on that about how they didn't have the correct team in place, because that was a unique scenario there.
Sure. Recently, a sale came to Justin, who is the individual working through the slides with us. He's a key component of the success of all of these programs we're doing virtually. An inbound lead came. There was an individual who was selling a marina on the outskirts of Palm Beach, and he was going to purchase a new one in the Keys. And his CPA and the estate planning attorney, they weren't very astute on the DST. Even though we had attempted to educate them, and it's a step-by-step process, they were just reluctant to articulate to the client to use the DST as a backup solution. So at the tail end of the exchange, the client solely identified a marina at the tail end of the Keys, literally Key West. So the transaction, long story short, was unsuccessful. The individual did not ID a DST. He actually sold his home locally and bought a home in Key West, thinking he was going to be living next to this marina. And, he was kind of sailing off into the sunset to have a new asset, and his retirement was going to be one level up from where he anticipated. Unfortunately, that was not the case. His proceeds are still stuck with an intermediary. He's earning no cash flows on it. I speak to him basically every other week, and you could just tell how demolished his spirits are, because this was his nest egg. It took him 30 years to build this marina. It was the largest liquidity event of his life. And unfortunately, the team he had around him was just not astute and not versed on the solutions that are in this current environment. And now he's scraping by looking for cash flows and attempting to top tick or bottom tick a stock market, which is, just a very, very tough ask. So we encourage everybody to use these DSTs as backups too. Even if you found an asset they actually want to move on, we're a great parachute, so to speak.
So a lot of folks, they think that they need to just ID one singular property. Not the case at all. You should ID at least the 3 property rule. A lot of people come to us for the DST as the parachute, like John Paul mentioned. So that way you can sleep at night knowing with surety that you're going to be able to close and not pay taxes. Because like John Paul said, that was that guy's nest egg. And now he's going to have taxes that are going to come due and have to live off a lot less of a dollar figure than he had prior. So what is the DST? We're talking a lot out there. The long and the short of it is that the DST was created in 2004 and it replaced the tenant in common structure. It's the new and improved tenant in common structure that allows the investor to be a 100% completely passive investor in large institutional grade real estate. And the DST is still 1031 exchange compatible because you're receiving fractional ownership, beneficial interest, and large pieces of institutional grade real estate. So institutional investment, you know, what is that? If you're not familiar with it, institutional grade real estate, if you're looking at that little slice of pizza over there, that's an institutional grade piece of real estate behind it. That's actually a Zurich headquarters out of Chicago. It's one of our previous offerings that we had. It looks like a Google campus or an Apple campus. The place is absolutely incredible. BBB rated tenant. They insure, don't quote me on this, but over 90% of Fortune 500 companies out there. So that's a type of asset that some of our clients were able to get that slice of pizza out of right there that you're going to see where it says your investment. And then the other investors are also participating in it underneath that. So the 1031 exchange replacement, really accredited investors having a menu to these types of replacement options and being able to replace the equity and the debt on the exchange. Because if you know when you're doing a 1031 exchange, you have to replace the equity portion and the debt portion, which can leave you scrambling as soon as you sell a property because now you have to replace your recourse debt with more recourse debt, and there's just a lot of components to it. So the DST came out 2004 and made this extremely turnkey and readily accessible for investors. More characteristics of the DST, passive ownership, like I said. We like to say this is a retirement tool for real estate investors, or it's a retirement tool for folks that have been doing real estate management their entire life. So you go from having maybe 200 tenants or 80 tenants or 20 or, you know, portfolio of some sort, and having to manage that or have a management company do it for you that you have to constantly be in front of and kind of, you know, keeping your eyes on. The DST allows you to be 100% completely passive. Also having the expertise of these large institutions. One of the institutions that we work with, just to give you an idea of what sort of quality they are, is Cantor Fitzgerald. Cantor Fitzgerald bought $60 billion of real estate last year. They're out there purchasing properties for DSTs, and they're the ones that are going to be managing the properties if that's the type of DST that you go into. There's many other sponsors that we work with as well. The debt on these DSTs, the sponsor will go out there, they'll purchase a property with their own money, which makes it not a blind pool. They package it together in what's called the DST, and then they'll put the debt on the property as well through their own financing terms with their own banks and lenders that they're working with. So you're getting the incredible financing terms that a Cantor Fitzgerald is getting, but you're not actually getting underwrote for the debt. So you're getting non-recourse debt on it.
One of the problems we're having up here with the COVID, the outbreak, is getting access to the properties, and we're having delays in getting the due diligence done, and as well as financing. And because 1031 exchange dates are sensitive, they did get pushed back to July 15th. It's still an issue, and we're getting extensions. And you had told me when we first spoke about, you know, the financing being in place, but you also mentioned that the due diligence is already done for the investor. And if you could just kind of touch on that also, because I know some of the people in attendance would like to know, what do they get prior to making a decision, and how that's to their advantage as opposed to worrying about getting the due diligence done and meeting that date, the exchange date.
It's huge. Yeah, that's huge, Rich. And, you know, it became a really well-known issue as soon as all this happened, right? I mean, how are you going to go out and do due diligence on a property if there's stay-at-home orders everywhere? So we've seen an incredible amount of interest in the DST, especially during COVID, because folks still had their 1031 exchanges coming up due. And the way that this makes it extremely easy, and the way that it makes it more so geared towards retiring for a real estate investor, is it eliminates all of that. So if you're used to looking at OMs, operating memorandums out there in the market on commercial properties, what we circulate to a client after we go through the entire menu of DST options that we have available, we'll actually circulate PPMs to them. The PPM is like an OM on steroids. I mean, it's more information than you're ever going to need on the property. we can direct the client exactly to the pages in the PPM of any information that they're looking for. All the due diligence has been done. All the third-party appraisals have been done. You have the pro formas, the trailing 12s, all the demographics of all the assets. So, and Rich, it's a great question because a lot of folks have a hard time actually understanding what the DST is. The DST is actual ownership in real estate. So you're getting beneficial interest in these large assets. So a lot of our clients who have been doing exchanges for 40 years, they're used to underwriting these properties themselves. So they do the underwriting on these assets just as if they're buying an actual property out in the market. So they receive a nice PPM on the asset or the types of, or the assets that we send over to them for underwriting, and all the underwriting's performed. They can even take tours of the properties if they'd like, as long as we're not, in a COVID situation. But you also brought up another great point, the July 15th extension. So the July 15th extension, folks are going to be waiting till the last minute. At least some of them are going to be. As we get closer, we're anticipating a large wave of equity out in the market that's going to need to be placed prior to that July 15th mark, which also may result in more people needing to do 1031 exchanges because people are going to be looking for maybe off-market properties and those sorts too. So at any given time, if somebody's looking for those, we can send them over to them and we can underwrite a property fairly quickly with them because it's just extremely turnkey and easy for them.
Tommy, one thing I'd like to mention too, because of the relationships that we have with the sponsors in the space, we can actually isolate equity 75 days prior to your close. And with what we're anticipating being a massive rush into the space and a lot of equity pouring into DSTs coming that mid-July mark, please feel free to reach out. We'll start to go over what the pipelines look like, and we'll try to figure out what's going to best suit your current exchanges.
Yeah, and it's a great point. It's really a team effort. Working with UMF, working with us, looking at properties out in the market, but also looking at the DST as a potential solution, which brings me to number 4 here, the diversification standpoint of things. The investment amounts on a DST are typically smaller, $50,000 of exchange proceeds or cash. About 30% of the proceeds that are in a DST are cash investors, but over 70% of them are usually 1031 proceeds. But what that does, that $50,000 minimum, is if Rich and his team are working on a deal and a client, sells a property, does a 1031 for $1 million, they find the perfect property for $800,000. It allows them to buy the property they want to buy, not the property they have to buy. So you can take that $200,000 sliver or the boot, and we can even replace the $200,000 with a little diversified portfolio as well. So like I said, not a blind pool. You know exactly what the property is, the addresses, the financing terms on them at the time.
When you decide to sell the DST, it does not necessarily, you don't have to go back into a DST. You have full flexibility to either call UMF up if the commercial property down the street that you've had an eye on comes available. You can go back and be an active manager, or you can pay taxes, or you can, and we always have a healthy menu of DSTs. You can invest in another DST. So you've got multiple options. You're not stuck in the DST structure.
One of the questions I had, sorry, is that is there a timeline? So if someone invests in a DST, is there a timeline that the sponsor has as far as when they'll be selling the property? Because I always get that. Is there a certain minimum number of years, or is there a strategy that's used?
That's perfect. It brings up the next slide here.
Okay.
So yeah, well, it's actually not on this slide. It's a great point. So we'll walk through that too. So the DST sponsor, the real estate company, we keep saying sponsor, that's the real estate company. They call them the sponsors. These are all the different items that are known at the time that you're underwriting the asset. This is a past offering over here on the right-hand side, multifamily project out of Florida. So Rich, when we place in a DST in front of a client and we have the PPM, everything's known about the property, we're walking through it. 328 unit Class A multifamily property, top US market like Florida. Purchase price was 80 million. The equity portion on that's 40 million. Debt portion, 40 million. That's non-recourse to the investor. The distribution is going to be known as well. It's a projection of the first year distribution based on whatever the occupancy and the current NOI is. All the properties are sustained. This isn't a scenario where they need to construct this property. Due to the way that the tax code was wrote, there can't be substantial improvements done to these assets like structural. So these are all going to be assets that are sustained. So the strategy, and getting to your question, is Usually they'll have a strategy that's associated with it. Maybe they want to increase the cash flow because they bought it from a regional owner. Maybe they bought it from a developer and, you know, it was at 88% occupancy. They're going to get it up to 93. If it's new construction compared to maybe if it's 2012 construction, there's going to be different strategies that are involved. Typically 3 to 5 year hold time projected, or 5 to 7 year projected hold time, or 7 to 10 year projected hold time, just purely depending on what the asset is and all the inner workings of it and how they purchased it and where they purchased it in the construction date.
Tommy, I'd also like to mention too, depending on the asset class, currently there's a lot of self-storage DSTs in the marketplace. One of the biggest and best sponsors that's in the space, they've been doing this almost 50 calendar years. They've been aggregating self-storage for about a year and a half. There's almost $700 million worth of self-storage that eventually will all get bundled up and likely sold to a publicly traded REIT, and or they will syndicate their own, giving clients options for a 721 and or a cash out. They did a very similar structure with the medical office roll-ups that they have access to, and that one's going to be liquidating probably towards the tail end of this calendar year, with returns coming in the mid-teens. So it all depends on the asset class and actual timing of what your current exchange looks like, and those are the different opportunities we'll drill down as we have these conversations and go over current situations.
Tommy, there was also a question about the DST as a placeholder while someone goes out to try to find another asset to purchase. Can you speak to the flexibility of getting into or out of DSTs?
Yes, so DSTs are illiquid investments. Once you're in the DST, you're in it until it goes full cycle and they sell the asset. So that's why we underwrite these properties, just like if you're buying real estate. You know, you want to look at it from a perspective of, okay, if I'm in here for 3 to 5 years or 5 to 7 or 7 to 10, typically our clients are completely fine with that because they're looking to retire from management. You know, this isn't a placeholder. It's not something that you put your money in and then you can pull it out in 2 years or, you know, whatever the case is. This is a retirement tool for real estate investors, or this is a backup solution for real estate investors who don't want to pay taxes, have 2 other properties that they're identifying, and they want to know with surety that they're not going to have to pay taxes and they're still going to have cash flow and be able to compound. Or it's for clients that are looking to fill that boot portion. But it's an illiquid investment and it's for accredited investors only. And all of our clients know that with full transparency when they're going into it. And everybody needs to be comfortable with that portion of it.
One thing I'd like to mention too, Tommy, I did see the question come through. Because of the dollar figure of this particular exchange, we could take that type of dollar amount on as an assignment. You know, basically anything that's $5 to $10 million plus, we can go out and customize a deal depending on what the client's needs are, match debt and equity. If it's an all cash exchange, we have the ability to isolate an asset that's incredibly stable, place debt on it in the following calendar year and create some liquidity events for the actual owners. So we're creative, you know, we're not shackled to the DST, and the larger the transactions are and the more time you give us to actually go out there, test the markets and see what the current pipelines look like, the sky's kind of the limit. But we cannot perform those type of transactions if you give us a 20-day window and say, I want a custom and self-storage, or, you know, I'd love to do a cash out refinancing structure, but you know, I have to get it done in 8 days and I want to get my capital out in 30. It's just not the way it works. The DST is a liquid. It's a longer term hold. They have clear visions on how they're going to be exiting the actual assets. But, you know, when we do have conversations, we could address really what your particular situation looks like. And if you fit those thresholds of the $5 to $10 million plus, we could drill down on some custom solutions that we've performed in the past.
Yeah, and even outside of the custom deals also, you know, it's funny. I have a client he's owned 75 different single family houses. They're all in a 10-mile radius from each other. You know, long-term hold type guy. Now he's in his 70s and, you know, he's in great health. And he's just kind of looking to alleviate those management responsibilities on some of the properties. They're starting to get older. He needs some improvements done to them. So he has 25 of them left. Every time I talk to him, he goes, Tommy, I wish that I knew you guys sooner because I would have put all of these into a DST because I paid taxes on over half of my portfolio. So he's an interesting case because he loves this because he's done 1031s in the past and he knows he'd have to scramble to kind of get replacements. So he calls me like a week and a half before each time he sold. So he sells a property and then he calls me a week and a half before the closing. Hey, Tommy, send over the list of DSTs that you think may be applicable for me. He's done multiple with us in the past. I know exactly what type of assets he likes. I know what types of offerings he likes. He knows which surety. It doesn't matter when his closing is. He's going to have our menu of DSTs to replace into. So he closes on the asset. Sometimes he waits maybe a week or 2 weeks, depending on, whatever it is. He's not in a huge rush like some of our other clients to not skip a beat on cash flow. But we go through the offerings with him, and then he just slowly builds a big DST portfolio over time. And he knows that whenever he closes, he's going to have those options for him. So kind of brings us to this next point here. Typical client owns appreciated real estate assets. Maybe you've received an offer or you're thinking about selling. And you've crunched the numbers and go, hey, I don't want to take a 20, 25 or 30 or 35% haircut on my proceeds. It's not worth it to sell, because I don't want to go into a Dollar General. I don't want to go into a Walgreens, or I'm going to have some sort of management. I'm comfortable with this because I've done it forever, but maybe there's potential for me to increase the NOI. There's just a lot of questions there, right? So a lot of our clients own those appreciated real estate assets and they're thinking about selling, or they received an offer and they don't know this is available to them. I mean, they can sell the property and then have a ready and available menu of DST solutions to go into it. So it just makes it really, really seamless. And that rolls right into the estate planning aspect too. If you have heirs, if you have children, given the small minimums on the DST and the fact that we can break this down to the smallest percentage of ownership, if you have 4 children, 3 children, or multiple heirs, you can actually break out multiple DSTs and have those structured in so your children receive those too, just so they're not all fighting over one property. Looking towards retirement, we've gone over that. Passive cash flow potential, it's exactly what this is. It's not having to have active management. And then escaping your local real estate market is a huge one too. Rich, I'm sure you've seen this before also, where folks maybe want to sell a property and exchange into multiple different properties after it because they're looking to spread it out a little bit. They don't want all their eggs in one basket. So with the DST, we can spread you out across multiple states, Dallas, Texas, Florida, South Florida, Tennessee. There's some markets that are really on fire right now. Maybe some clients want to exchange out of their local market and get exposure to some of those markets in different asset classes. So the 1031 exchange option, just having the quality replacement solutions to be able to source when you need them. Rich, I'm sure you can kind of speak to this too in 1031s,
Yeah.
Seeing so many of them throughout the years, how people think that they're a stressful transaction, but they're not if you have the right guys around you.
If you have the right team, I'll use an example. Last year we sold a 54 unit brick in Jamaica Plain. The owner had relocated to Boca Raton the year prior, and he really wanted to buy something near his house in Boca. So we went out to the top 10 buyers, put it under agreement within 30 days. And we went out and started looking around. We looked on all the usual places for a listing like LoopNet, CoStar. Couldn't find anything because you're never going to find a 50 plus building, attractive building on the open market. So we started making phone calls. We made several hundred phone calls, found a major player down in the South Florida market. We ended up selling this particular seller 53 units with the right to build 55 additional units. He's a builder because he had built the 54 units with his dad 5 minutes from his house. So he rides his bike to the back and forth every day from his house now in Boca. And
Florida
we're in
life.
the process. Yeah, and we got into financing. We're helping him with the management, from here. But I mean, he's in the process of breaking ground now. He's going to double his units, easily double his income. And it's a tax-free state. 5 minutes from his house that he can watch over the management, which he wasn't able to do when it was here in Jamaica Plain. But a couple things I have a quick question on, and I know this came through from some investors or attendees, I should say. Sorry, Tommy. Everyone asks, like, cash flow, is it paid out monthly on the DST, and how is that all figured out? Is it like a regular property where they do, the accounting and then they show the investor? If you could answer that question, that would be helpful.
Yes, so we actually have a slide too that I put in here that basically breaks down a hypothetical DST portfolio that we've built for somebody. And we can click over to that right now, actually.
Okay.
So this is a typical DST client allocation, example kind of here. Let's just say a client sells a property for $20,750,000. They have 11.25 in debt on the property, and they're coming in at a 54% LTV on that. So this is a typical portfolio that we could build. These are all past offerings that we've had on our platform before. 30 triple net lease properties. These are Tractor Supply, DaVita Dialysis, Fresenius, Dollar General, Walgreens, just a mixture of them. 30 different BBB rated triple net lease properties spread out across 8 states was one of them in the past. E-commerce distribution center, could be an Amazon center or a FedEx distribution center. Class A multifamily property, 3 property portfolio, storage, corporate headquarters like we talked about, Zurich, senior living, this whole mixture here, right? And I believe, Justin, didn't we have one with the cash flows on there too? There we go. So just to have the cash flows on here too, these are projected cash flows on it starting, right, first year, and these are going to be paid out monthly. Over 90% of the DSTs typically are on a monthly schedule that are paid out. Rarely they're on a quarterly schedule. They could come up where they're quarterly, but typically they're on a monthly schedule paid out, just like if you own a regular property and you're getting that monthly rent payment.
One of the things you mentioned also is as far as getting away from the active management on a property. And I know we discussed is that, even though you get into a triple net lease, you might have, McDonald's, whatever, and you have like a Starbucks who just sent out a letter to all the owners who are leasing to them that they're looking for a 1-year reprieve on rent.
Yeah,
And
I can't believe that.
Yeah.
That was intense.
Very intense. And who knows what's going to happen from there. But, if you're a large institutional company and you're managing your property, you know how to deal with those folks. If you're a mom and pop and you bought a single standing Starbucks and now all of a sudden they're telling you that you're not going to have rent for a year, I mean that's a good thing. I would think as far as the management that you bring, also the DST brings, that you're away from having to renegotiate.
Yeah, it was a shame seeing that come out about Starbucks, especially for the developers that are out there that are developing them and trying to sell them for really competitive cap rates. And, folks that have those regional centers where Starbucks is their golden child in there too, it's going to affect all that because, how you act during this is, how you're going to act potentially during the next one too. The DST and having that management team that's in place, they're not going to take that laying down. I mean, they've been through all this before. The triple net lease portfolio company that we work with, they've been approached by Hobby Lobby and a couple other real estate, a couple other tenants that were in their past portfolios for rent relief. And they're like, they have a law firm in place to be able to approach them and say, yeah, there's no way that's going to happen. You're going to need to do more than that. But a local regional owner gets hit hard with that. I mean, I felt like when that happened, I felt like Starbucks was really targeting just the regional guys that aren't as savvy enough to know they don't necessarily have to give them that rent relief and they just want to be nice to them to keep them there. So so it brings you a whole nother level of a team that's involved on the portfolio. And Rich, it's a great point. I mean, you don't have to deal with that. That's something that you're not actively having to deal with yourself. You have a team in place with the DST that's actually
you're professionals that deal with it day in and day out. One thing I forgot on one of the slides, and someone had asked me this question, we discussed the reverse exchange, but a lot of people want to know like the forward exchange. How does that, that's one of those things that a whole lot of people don't understand as far as how does that work as opposed to the reverse exchange. If you could kind of get into that a little.
Okay. So we don't see a lot of reverse exchanges. Reverse exchanges are a little bit more on the rare side, just because, actually we were seeing more of them when it was, when the inventory was extremely low out there.
Typically too, in the reverse exchange, the way it works is the investor isolates the asset and they will have the capital to actually purchase it, but they never take constructive receipt of the asset. So the actual intermediary company, whoever they use to facilitate that transaction, they will set up the escrow account. The client needs to produce the capital to go out and acquire it. And they have the same amount of time frames and deadlines that a typical 1031 has. And that's about a $6,000 cost. It could range from $6,000 to $10,000, depending on how many actual assets that particular exchanger is going to be doing a reverse exchange with.
Yeah, and Rich, I just want to clarify too. Are we talking about buying a property first in an exchange, or are we talking about just a regular 1031 exchange?
So someone goes out, they buy the property, and then I guess they allocate the
Sure.
property. They designate the properties they're going to sell. And those properties have to close within 6 months of the acquisition of the property they're actually buying. That's my understanding of it. A lot of times it's done. You see a lot of it when there's construction involved, where someone buys. They sell a building, they buy a piece of land, and they're going to put a structure on there. They might build a multifamily. I know there's the same timeline, 6 months or whatnot, but that's some of the questions some of the people had earlier.
Yeah, they are going to be more expensive when you buy first and then still do the exchange, like John Paul's saying, because the qualified intermediary company is actually the one that is technically purchasing that property prior to the investor, because you can't take constructive receipt of the exchange proceeds when you're doing a 1031 exchange. So it's more complicated. There's more obligation on behalf of the qualified intermediary. So they can be more expensive, but when you're seeing, when you see a property that you don't want to pass up on, and you know that your property can sell with surety in that 6 month time frame, it's something to consider. We have seen them done before.
One of the things I find very interesting, and when we did our first call, is that we're speaking about the customized, the private options that you have. Like a lot of times you have the sponsor, they put it out there, $50 million property, 6% yield. You can buy it in chunks of 100,000 each share or percentage of ownership. And then we had a discussion on if someone sells, and I know that John Paul had touched on this earlier, someone has 5 to 10 million, and now they can kind of get into something that's not a larger fund, but maybe a smaller fund with a particular property. Did you have any examples? Because I know there's some people on here right now that would be interested in that.
I'll give you a couple for instances of what
Sure.
we did in the past. In that large transaction, that 176 million DST portfolio, there was 20 different family members, 12 different LLCs kind of commingled into that particular sale. It was a large assisted living facility in upstate New York. What we did is we broke them into a range of DST products, and they were taking slivers of the best possible assets we had on the platform. We were also earmarking equity that was coming down the pipeline, because that's a large dollar amount to place. Inside of that exchange too, we took a $40 million custom deal, and we went out and we isolated a multifamily for them. The actual equity, the equity that needed to be replaced, was $52 million. So the overall transaction was $176 million. So we mixed and matched the debt equity ratios to make sure we successfully completed that transaction. We had another client exchanging out of Michigan. The family really loved self-storage. We took on an $18 million self-storage assignment again, and that was an all-cash sale. They had an older father who was looking to kind of create liquidity for the family. All of the siblings, they wanted the money. That's something you see commonly. Mom and dad have done a great job. Siblings need some money, whether they're starting a family or, looking to open up their own business. So that was an $18 million all-cash purchase. And then we went out there, we isolated the scenarios. We did a joint venture with a group called Inland. And then the following calendar year, we put 65% LTV on that particular asset. And the father was able to give the siblings each an equal share of that cash that they received and recouped, completely tax-free. Those strategies aren't easy, and we need a lot of time to actually participate in them, but they're a unique tool that me and my team do pretty regularly. Currently, I'm working on a $90 million exchange. The client wants to be spread out amongst multiple asset classes, and I'm 6 or 7 calls deep with 5 sponsors, customizing a portfolio that's going to consist of medical, multifamily, industrial, student housing, and assisted living. And each one of those is going to be earmarked for about a $10 million allocation. And then he's got a Wild West bucket. There's nothing Wild West about what we do. What we do is capital preservation, tax deferment, and income streams. So I'm almost deferring that bucket to some of the other people on this phone call, which is the conversation I had with you prior to this, Rich. You know, he's looking for some other things, maybe tangible assets that he could actually go out and acquire. So every case is going to be very different, and depending on the dollar increments and the overall desires of the client and the amount of lead time they give us to complete these type of transactions, the sky's kind of the limit. We could do our very best to create whatever mix and match of debt equity you guys are looking for, but it's not it's not a fire drill. We can't do them in 20 days.
Yeah.
And the $5 to $10 million assignments are the typical. You know, the bigger, the more freedom we have and the more opportunities we could tackle as a team.
Yeah, and those sizes there too, you know, the 5 to 10 million. I mean, the menu that we have 17 different offerings on our, 16 different offerings on our platform right now. You know, they can range from really large equity slugs in there. I mean, it could be $40 million just for one single DST or upwards of that. And these lists aren't something that's broadly based, you know, broadly sent out. So the menu that we always have access to is going to be kind of an off-market scenario to real estate investors that are out there, because they're not going to see these types of, you know, this type of equity available anywhere. And the larger the dollar figure, like John Paul's saying, the more custom that we can get. But I mean, I have a client that we work with, all of us work with. He has a huge portfolio, $100 million real estate portfolio, typical, sort of similar to this case right here, $100 million real estate portfolio. And he's exchanging out of Walgreens. You know, he's not a fan of Walgreens right now. He's exchanging out of Applebee's right now because he doesn't like what happened during this COVID scenario. He has zero debt on his entire portfolio. And he knows with surety he's going to have this menu to be able to replace into. So $3 million, all equity, zero debt. You know, that's a good amount of equity that you're rolling into something. Obviously, the larger the dollar figures, the more custom we can get, Rich. Need some lead time on it. But at the end of the day, the current menu that we always have available, you know, it's almost like it is an off-market scenario, because we do around 250 million year over year in 1031 proceeds. So our menu is second to none. And what John Paul and his partners have done has been incredible in a sense of just having really in-depth access to all these large institutions out there to do those custom deals. Not everybody can do those.
No, that's helpful. And that's the one thing that really impressed when we spoke, that you are able to customize transactions for clients in that value range.
Even inside of the menu, though, what the DST enables us to do with the cash, actually the debt equities ranging from all cash and as high as that 83% levered, we could get very creative. You know, so the client doesn't necessarily feel like they need to take on just one asset or two assets. They could be spread out amongst 8 to 10 different DSTs, and we could literally match the perfect debt equity ratios that they're actually looking for.
Yeah, this slide here this is our website actually. Clients can actually go on here. We can give them access once they fill out some questions, and you can see the full property list on here. You know, for anybody who's doing a 1031, 1033 exchange, they're looking for access to the menu. You can go on, browse the properties in real time, and you know, give us a call and say, hey, I really like this one. I like that one. You know, let's go over this in more detail. And, you know, that's kind of how it works. You know, we have an initial conversation with somebody, with their team, you know, anybody who's involved, the CPA, attorney, UMF, you know, anybody who's a strategic advisor. We're glad to get on the call with anybody, walk through all of these scenarios, and, you know, just start laying out solutions. You know, Rich, I know we talked about one individual that you guys were working with, and we had a call with him, and we found out, you know, the 1031 wasn't the best thing for him because he had a high basis due to getting a step up in basis from an heir passing away. So, you know, the calls that we field with anybody when we're doing these consultations is really just a fact-finding call, trying to figure out what the inner workings of the deal are, and then figuring out the best approach after that. And all it is at the end of the day is, like you guys know, you know, putting solutions in front of people, putting different options in front of them, and just giving them the slew of different opportunities they have out there. So, you know,
I think that's important what you just said, Tommy, when we did our call, and it just so everyone on the webinar knows. So someone sold a property, and they had a decent sized deal, and so we had them call, and so I'm not sure if they spoke to John Paul or Tommy, and so they
it was
did a
all of us actually.
All of you, okay?
Yeah, we had a couple of us on the call. Yeah.
Sorry. So they did a consultation. So they weren't looking just to sell something to someone. They actually went through where the person stood as far as their basis and their whole, you know, they had the father passed away, he left it to the kids, so they had a step-up basis. These guys actually went through and looked at where the person stood, and they actually consulted them, and rather than just take a fee for selling something, they showed them the right way to do something. So, I mean, that's what impresses me about the fact that they actually take the time to consult. I think that if you're in an exchange or thinking of an exchange, that, you know, it's to have someone that's an expert kind of show you what you can do, you know, rather than just try to do it on your own. And by the way, I think a lot of times people have they see 5% return or 6% return. Oh, it's not high enough. The reality is when you get through all the expenses on a deal and then your time, you know, 5% is the new norm. That's what, you know, if you're getting that, you're doing pretty good. So,
Yep.
I mean, that's something to keep in mind when you're in professionally managed, you don't have to do all 24/7. I know some people like to still replace toilets and whatnot, but I mean, you get to a certain age, you want to retire and, move to Florida or whatever to have the time to spend with family. So these guys do a great job of doing that.
Well, no, we appreciate it, Rich.
Just it, Rich. At the end of the day, when people have accumulated their wealth, they want capital preservation and they don't want to actively manage their real estate anymore. That's what these vehicles are for. We'll avoid the taxes. We'll create consistent cash flows for you. We'll spread you out amongst multiple asset classes, but we're agnostic and we could literally provide the best-in-class type of assets, providing quality of life for those that are really looking to retire, not deal with the phone calls that we all know are associated with the landlord. And unless you have a incredible property manager, asset manager, those calls come in any day, anytime, consistently. So.
Well, we spoke with another individual the other day. He's got his property listed for sale. It's a small multifamily property, and it's way overpriced. I mean, the broker said it should be at 260, and it's at 300, and
that's a surprise.
And I get it too, because he's not doing a 1031. He's not doing a 1031 on the backside of the sale. So he's factoring in 20, 25, 30, I don't know his tax bracket, 35%, whatever it is, of a haircut. So he's going, well, I need to get X amount for the property, because then I'm going to take my proceeds and then I'm going to go park it at my bank or my financial advisor and try making 7%, after I took a heavy haircut. So, now we're communicating with him, educating him on the fact that, hey, you can do the 1031 exchange. You can use the DST compound, take your full 2.3 instead of the 2.5 sale, and move that down the road and get 5% or 5.5% or whatever it's going to escalate up to, instead of taking that hit and then thinking about what you're going to be able to have, because he wants to retire, so he's thinking about it as his nest egg. So it's changed the whole convo and even potentially the price that he needs for the property. So now he can actually sell it because it's just sitting on the market overpriced. So, strategies like that are something that, we do a lot of. Actually, we field a lot of calls like that and just kind of opening people's eyes a little bit.
We see the
and
same
when there's that sliver that's excess inside of each and every exchange, which there usually is, you typically can't find the perfect dollar amount that you want to replace. Think of us. The minimums on the investments are small. We could probably squeeze a 50K ticket in, but the minimums are 100 due to the volume we do. We can get exceptions. But one thing I did want to mention, Rich, as time goes on and we start to see the markets heat up, investors, they're going to need some other solutions too. And what I think may be fruitful and beneficial for everybody on this call, maybe there should be a follow-on segue into how clients can participate in the sales that you guys are able to provide them, take their bases off the table, and or roll into a multifamily and simply roll their gains into an opportunity zone fund. And we could give them a brief education on what those things could look like, because it's just another tool to avoid taxation. There's some incredible legislation that came out in 2017. Me and my team are on the cusp of some incredible offerings right now. And the more access and the more vehicles you have to really maximize your client sales, the more powerful as a team we can all be.
That's a great idea, because I've had many people ask about the opportunity zone. So I think we should definitely do a follow-up as well.
Great.
Yeah, we'd love to do that. It's another option. And, you know, a lot of people call the OZ, you know, 1031 exchange on steroids, you know, and it's doing really well. I just sent the whole team the other day an article on how 3/4 of the opportunity zone areas that were designated OZs, the single family house prices have gone up there substantially. So that's a great analytic to see. I mean, it's working. It's the first time that real private capital has been dished out in these areas to be able to see some gentrification. It's only going to help all the surrounding areas too. So it's a different type of investment, and we have full presentations on all of that as well. We've done a lot of opportunity zone fund work, and this is that article right here on the screen. If everybody can see that there, if you guys want access to that and a slew of other information that we have a ton of articles that we can share and Fortitude brochures on 1031s and DSTs. This article here just kind of walks you through the exact transaction that we did. That was the record-breaking DST transaction of 176 million in Q4 2017. So we're glad to shoot that over to anybody there. Yeah, and
Rich, you have any or anything else you want us to touch on?
No, I think everything that we've touched on, everything, the questions I had. I guess
Good.
one thing real quick, if you don't mind me going back, just for everyone on the line. So you mentioned about the sliver. So say they sell a property for $1 million, or their replacement property should be at $1 million, and they find a deal they really like, it's $800,000. So that $200,000 difference, what you're saying is that someone could get into the DST for that $200,000 so that they qualify for the full exchange and don't have to pay on the supposed food, as they call it. That's
Yep.
what you were mentioning? Okay.
Yep.
That's correct. Dollar for dollar exchanges can be done amongst pretty much any sort of debt equity ratio. So there's no need to pay taxes when you have these institutional grade slivers you could participate in.
Good to know.
Yeah, it's a great tool, and the backup tool is huge too. I mean, we do a lot of backups. We call it the parachute, you know, because you're doing an exchange, it's your nest egg, or it's just you've been kicking the can down the road forever in these exchanges. You want to know that you have something that you're definitely going to be able to close into and not pay taxes on. So we do a lot of the parachute, IDing as the third replacement solution for the DST. And then the boot portion is huge. I mean, I say it all the time, buy the property you want, not the one that you have to buy. Because when you do the exchange, everybody thinks have to replace equal greater equity and debt in the next property sale, no doubt about it. But they don't know that they can actually do a sliver and not pay taxes on the full amount by just placing 100K or 200K into a DST. And even more so, something really underrated about the DST is using the non-recourse debt. So if you want to buy your next property all cash, we can actually sliver out the equity portion with the debt on some of these high LTV deals that we have. Replace the debt that you have that's recourse with non-recourse, so the next property that you buy is all cash. So we can take on all the debt through the DST, so you can kind of have freedom going forward too. And then that's just kind of coasting and riding on one of these large institutional grade assets, because typically the high LTV deals are just, you know, they're trophy assets in the best areas. I mean, Zurich headquarters, if anybody wants to Google it, Zurich headquarters out of Chicago. I mean, it looks like, you know, a Starship Trooper building. It's just, it's incredible looking. It looks like a Google campus inside. So that's what would be chipping away at your debt. It's a really underrated feature of the DST.
Yeah. And at the end of the day too, don't let the myth of the 1031 scare you from asking all of us on this phone call how to participate and facilitate these things. The 3 rules are easy. You literally just need the right team and the right individuals quarterbacking everything. And it's what we do all day, every day. And it would be our pleasure to field a phone call from you all.
Hey, Tommy, maybe one more question and then call it a day here. Somebody asked about the average lifespan of a DST, and do most people keep rolling into further DSTs after the initial one?
Yeah, so average lifespan is going to be 3 to 5 years, 5 to 7 years, or 7 to 10 years, depending on the strategy. There's always going to be a strategy on the asset. We're going to walk through all of that with the client. Sometimes the clients want to be in these things for 7 to 10 years. They just want to kind of put it in, see it appreciate over time. They want to be in brand new assets. So that's what we do for them. Other clients like to have the flexibility of having some of that cash maybe available a little sooner. So we'll carve out some portion of that in a 3 to 5 year projected hold time. And on the back end, typically what happens is you'll receive a letter as an investor on average right around 60 days prior to them closing on a property. They'll send out a letter to all the investors in there and say, hey, everybody, get ready for our next exchange. We're selling the property. These are the sale proceeds. If you want to do another 1031 exchange, get your team in order. If you want to cash out, that's up to you as well. And then you just prepare for another 1031. And usually when people go into the DSTs, they stay in the DSTs, or they start transitioning additional assets into the DST. They just realize how easy it is. A lot of them are in their retirement years. They're trying to set their kids up. Their kids do not know how to manage real estate. We see that a lot. I mean, they come in and they go, man, dad or mom, they did a really great job setting this all up, but I don't know what attorney to call if this happens, or the plumber, or whoever it is. So they want to set their kids up appropriately. So typically on the tail end, they're rolling into another DST, and they're just sort of compounding it down the road and setting it up for an estate plan purposes. And then once they pass, upon their passing, their heirs will get a step up in basis. And then when they sell the DST or go full cycle with it, at that time, the heirs can liquidate just as if they would if they inherited the property out in the market and cash out. But typically they stay in after they get in addition and sell more properties, because they go, man, that transaction was easy. I thought 1031s were hard. So typically once they see how seamless it is, they do multiple and then they stay in them, from what we see. Yeah, so Rich, we really appreciate you having us on here today. Great group of people. You guys do an incredible job up north too. It's been an absolute pleasure getting to know you guys and working with you guys. We can't say enough about what you guys do. So we really appreciate you having us on here. We look forward to doing another one with you guys if we want to do it on Opportunity Zone funds as well. We have a great presentation on that, and just providing options to everybody out there. So again, hope everybody stays safe, on the call today. And Rich, thanks again. We really appreciate the time.
You're welcome, Tommy.
Definitely. Continued success throughout the year.
Definitely. Same to you guys. One thing, anyone that's attending, I think if you have a property, if you're thinking of doing an exchange, I think there's so much at stake when you discuss a potential tax consequence when you do sell a property. And so with that said, planning ahead instead of waiting to the last minute is critical to preserving your wealth, like Tommy, John Paul, and Wolfgang have mentioned. I'd say in order to take full advantage of the various investment opportunities that Fortitude offers, be wise to know, when you do sell, how much equity you'll have to reinvest, and what will the value of the replacement property have to be. So one of the services we provide is we provide owners at no cost or obligation, just like a consultation. We let you know what your property would sell for in today's market. And with that, you'll have the confidence to sit down with Tommy, John Paul, or Wolfgang on the phone and do the consultation, which I'm impressed by. They tell you, they're not there just to sell a DST. They do consult you what you can do to preserve your wealth for yourself and your heirs. So, if you are, feel free to contact us. We'd be more than happy to give you a market analysis. And then from there, of course, I'd reach out. If I were you, I'd reach out to these guys and have a consultation with them. But thank you guys.
We appreciate it, Rich.
Thanks,
working
Rich.
with you guys.
Thank you. Thank you, everybody, for your time. Everybody have a great day.
Thank you.
Have a great day, everybody.
Take care,
Take care.
everybody.